Hey everyone, welcome to The Explainer. You know, it's wild how one tiny spark on one side of the planet can instantly set off this massive chain reaction across totally different asset classes all over the world. Mid-June 2026 gave us a textbook example of exactly that. Today, we're going to break down this global market domino effect. We'll look at how a sudden geopolitical shift instantly rippled through macroeconomic indicators, set the Indian stock markets on fire, and completely shook up the precious metals market.
Here is our roadmap for today. First, the setup. Second, the geopolitical spark. Third, Indian equities explode. Fourth, precious metals new phase. And finally, what happens next?
All right, let's jump straight into part one, the setup.
So before any of this geopolitical news broke, global markets were literally sitting on a knife's edge. And a massive reason for that? Inflation. In May of 2026, the U.S. Consumer Price Index, the CPI, clocked in at 4.2% year over year. That's the fastest pace we've seen in over 3 years. A lot of this was driven by soaring energy costs tied directly to the conflict in the Middle East. And this stubborn, sticky inflation had investors seriously sweating over whether central banks would be forced to keep their monetary policies heavily restrictive.
But wait, because behind the scenes, the pressure was really compounding. The U.S. Producer Price Index, the PPI, shot all the way up to 6.5%. Remember, this tracks wholesale price pressures before they even reach the consumer. When you've got both the CPI and PPI coming in this hot, well, you have a total recipe for market panic. The big fear here was that the Federal Reserve was going to be backed into a corner, completely unable to ease up on interest rates. So that was our powder keg. Now let's talk about the match.
Which brings us to part two, the geopolitical spark.
Almost out of nowhere, we saw global market sentiment do a complete 180, all based on the prospect of an imminent peace deal. According to the reports, U.S. President Donald Trump announced that the U.S. would actually step back from planned military actions, stating, "We are close to a great settlement to end the war." Now, strictly looking at this from a financial perspective, putting politics completely aside, the mere possibility of avoiding a major disruption to global oil infrastructure triggered a massive, immediate recalibration of risk on trading floors everywhere.
Just look at how incredibly fast this narrative flipped. On June 11th, we were looking at peak escalation. Iran called a ceasefire meaningless, global markets were rattled, and IT stocks in India took a really heavy hit. But then, early on June 12th, those peace signals dropped. Fast forward to late June 12th, and bam, we see the direct market fallout, a huge relief rally in energy, with Brent crude oil crashing below $90 a barrel. It was like a giant pressure valve had just been released.
Moving on to part three, Indian equities explode.
Now, to understand why India reacted the way it did, you have to look at how their benchmark index, the Nifty 50, is actually built. A whopping 36% of the index is weighted heavily in financial services. Why does that matter to us? Well, when global oil prices suddenly dropped, it instantly took the heat off domestic inflation and current account deficit fears in India. That fundamentally changes the game for banks. Because financials completely dominate the Nifty, when the Bank Nifty jumped an absolutely wild 1,638 points, it practically dragged the entire broader market up right along with it.
And the immediate result on Dalal Street was nothing short of explosive. The BSE Sensex surged almost 1,700 points to close at 75,527. Literally every major sectoral index ended in the green. Investors were just aggressively cheering this super rare combo of easing global tensions, plummeting oil prices, and a massive sudden return of global risk appetite. Honestly, it was one of the strongest trading sessions we had seen in weeks.
But you know, if we actually pop the hood on this rally, there's a really fascinating tug of war going on. Look at this trading data from June 2026. Foreign institutional investors, the FIIs, they were actually net sellers, offloading almost 40,000 crore. But on the flip side, domestic institutional investors, the DIIs, aggressively bought the dip, pumping in over 30,000 crore. What this tells us is there is a gradual transfer of equity ownership happening, and it proves that strong domestic liquidity was the ultimate shock absorber that kept the market sentiment super steady.
All right, let's pivot to part four, precious metals new phase.
To really grasp what's going on with safe haven assets right now, we have to zoom out and look at the past 12 months. Yeah, sure, metals pulled back a bit from their crazy all-time highs in January 2026, mainly because of those sticky inflation fears we talked about earlier. But just look at this year-over-year comparison. Gold is still up an unbelievable 36%, and silver has literally more than doubled, up 133%. So what the experts are saying is,
Guys, this is absolutely not a failed rally. Actually, we're witnessing a historic consolidation phase right in the middle of a massive structural bull market. The key here is understanding the wild forces pulling on these metals, especially silver. Silver is dealing with what analysts call a dual driver problem, which ironically is also its biggest opportunity. On one hand, you've got this immense upward pull from structural industrial demand. We're talking solar panels, EVs, AI data centers, all combined with 6 straight years of global supply deficits. But on the exact opposite hand, you've got this downward gravity from cooling speculative investment demand and a really strong US dollar. It is a high-stakes tug-of-war for sure.
So, how do smart money investors figure out where the real value is in all this chaos? They use a crucial metric called the gold-to-silver ratio. Simply put, it just tells you how many ounces of silver it takes to buy 1 single ounce of gold. It's an awesome tool to quickly spot if silver is currently trading cheap or if it's getting expensive compared to gold, based entirely on historical averages. And right now, in mid-June 2026, that ratio is floating right around 59 to 64 to 1. Historically speaking, when we see a ratio near 60, it tells us silver is fairly valued, maybe even slightly rich compared to the 20-year average of about 68 to 1. But, and this is a big but, a lot of experts are arguing that silver's totally relentless industrial demand story could easily justify driving this ratio even lower in the future. And man, we absolutely cannot talk about precious metals without highlighting the insane reaction over in the local Indian markets. Fueled by all those global factors we just walked through, the physical market literally exploded. MCX gold smashed right through the massive rupees 150,000 lakh mark per 10 grams. Down in Chennai, they saw the absolute biggest hike of the day, with physical gold rocketing up by 34,000 rupees per 100 grams in a single trading session. Just wild.
That brings us to our final section, Part 5, What Happens Next?
If you are actively watching the markets right now, there are 3 massive catalysts you need to have on your radar for next week. First up, the June 17th Federal Reserve policy decision. Even if they hold rates steady, the exact language they use around inflation is going to completely steer the market's direction. Second, we need to see if this U.S. Iran peace deal actually becomes official or if it was just talk. Getting hard confirmation there is absolutely key. And third, we have to track whether crude oil can actually stay stable below that $90 threshold. If any one of these 3 things pivot, we're going to see those dominoes start falling all over again.
So with all this crazy volatility, what are the pros actually doing? Well, smart investors aren't panicking, they are getting highly strategic. They're actually using this consolidation phase to dollar-cost average into gold and silver whenever there's a dip. A lot of them are heavily prioritizing silver just because of that massive long-term industrial upside we talked about. They're also throwing copper into the mix as a smart diversification play. And maybe the most important takeaway, if they are taking profits, they're only selling small chunks, making sure to keep their core long-term positions totally intact.
Which really brings us to the ultimate question we have to leave you with today. We've just watched this incredible, massive relief rally across global equities and a really fascinating reset in precious metals. But ask yourself this, is this geopolitical peace deal truly going to hold up, giving inflation a chance to cool down and letting the markets run? Or are we all just sitting quietly in the eye of the storm? Keep a close watch on those charts, stay focused, and I'll see you in the next explainer.